Let's go ahead and get the show on the road, as they say. Today, we are joined by Matt Potter, who comes to us from SEI. Matt is the Director of Investment Services. He's going to be giving a presentation today on basically SEI's perspective of what are some things that have happened recently in the investment markets and maybe a look towards the future. What are some things we might be able to expect on the horizon? As I said, Matt is the Director of Investment Services at SEI. He does a lot of road shows kind of like this. He's out on the road normally in normal non-pandemic conditions, meeting with clients of advisors who work with SEI. And prior to joining SEI, Matt was principal and head of client service for Lockwell Investments, a boutique small cap value investment manager. And previously, he was also a client portfolio manager for Invesco, a portfolio specialist for Morgan Stanley Investment Management, and a performance analyst for Janney Montgomery Scott. It's quite a resume you got there, Matt. Matt's also a CFA charter holder and a great speaker as well. I'll add that in there too. So just a couple of housekeeping issues before I turn it over to Matt. We're going to hold questions until the end. So if you have anything as we're presenting and talking about some of the topics Matt's going to be reviewing, feel free to enter those into the questions box and we'll hang on to those. The presentation, Matt said, is about 30 minutes or so. And then after that, we'll go right into questions. So without further ado, I present you Matt Potter.
Great. Thanks, Jared. And let me go ahead and share my screen. Hopefully you are all seeing what I'm seeing, the client investment review cover. And so, yeah, we're going to, I'm going to talk today a bit about, what we saw in the markets, what we've been seeing a little bit year to date, and, where we think we see things headed. Also, a little bit of a section on diversification. I think I've shown this slide a few times back, but it's been a little while, and I think it's a good lesson as we go into a period where leadership in the market may be changing, and I think it's good to keep the idea of diversification in mind. So let me advance the slides and go right in. First of all, we like to show this slide where we give several aspects of the economy, and we show what our expectations were for calendar 2020, which is the box in the 2020 line. Then what we actually saw in 2020, which is the check mark. So the distance between the box and the check mark indicates how accurate or inaccurate we were. And then the box for 2021 is what we expect to see this year. And it's always interesting to look back. I think the last time we did this presentation, we were talking about the elections. And certainly going into 2020, at that time, we thought the biggest risk that was facing the markets was geopolitical risk. Otherwise, we had a reasonably positive view of what could happen. But of course, COVID-19 had other ideas, and we experienced a severe economic shock last year. On the heels of that, there was a very strong response from the federal government, both the Federal Reserve and also from Congress and the White House. And so you can see, while last year was a challenging year for things like economic growth, labor markets, we do expect a continued expansion this year. We think the combination of both the vaccine rollout and just really kind of being able to get the pandemic under control, or at least learning to live with it, along with some of the supportive measures, including the most recent fiscal package that passed, all of those should help to support the economy going forward. And so we are fairly positive on the expansion that we think has just begun. Towards the bottom, I think areas like geopolitical risk, investor sentiment, probably less relevant now than what they have been at some points in the past. But really, I think the big story last year, obviously, was the pandemic in the first half, and then maybe the election in the second half. But with the election in the rearview mirror, it really does seem to be the pandemic and vaccine rollout that are likely to devote most of the attention for the better part of this year. Now, in terms of what we saw with the markets, the gray bars here represent what we saw with markets last year for different asset classes. And then the green bars are for the first 2 months of this year, so the year to date through the end of February. We have seen some more market activity recently. Today was kind of a tough day for stocks. We did see some reaction to the Federal Reserve's comments and some concern about the possibility of inflation and rising interest rates. But at least you can see from last year, it turned out to be a fairly positive year, despite the volatility that we experienced during the first quarter of 2020. Markets really recovered strongly and quickly. As I had mentioned in a previous presentation, it was a record quick decline and a record quick recovery. So when you hear words like unprecedented used to describe last year, in many ways, that is literally the right word to use. So for the stock market, one thing that we did begin to see, and I'll talk about this in a little bit more detail, was something that looks like it could have been a change in leadership, which we think may be persisting. And you can see there are a couple of areas where, for example, while U.S. stocks led non-U.S. last year, and certainly that began to change, at least looked like it was beginning to change in the fourth quarter. We also saw leadership kind of move from larger stocks to smaller stocks. And we also saw some style changes in terms of what was leading the way as well. Bonds had a pretty positive year last year. This year, it's been more mixed. More attention has been given to interest rates and their direction and the Federal Reserve. And at this point, that has started to generate again, some mixed results within that asset class. And I'll get into that in a little bit more detail. And certainly this year, we've begun to see more of a recovery in commodities, whether it's oil prices, whether it's industrial metals. We've certainly seen that area of the market. And that tends to be often is associated with inflation. So I think that's another indicator that the market maybe is starting to express some concerns different from what was anticipated last year. In terms of stocks, and again, these numbers here are through the end of last year, but again, many of these trends continued through at least part of this year. And you can see that last year, and for some reason, the full year results are in green this time, and the fourth quarter results are in dark blue. Last year, the real leader was technology. And this was unusual. Yet generally when there is a bear market like we saw in the first quarter of last year, that's typically when more defensive stocks, utilities, consumer staples, when those tend to hold up best as people kind of rotate out of riskier names into names that are seen as more stable. That really didn't happen last year. It was an unusual occurrence in that the stocks that did well during the pandemic were many of the same ones that kind of persisted in doing well throughout the whole year up until the fourth quarter and this year. You can see that turn in terms of value versus growth. There was that shift that we saw from more growth stocks growing their earnings faster than the economy or than the market as a whole, to stocks that are cheaper, that often tend to be in more cyclical or economically sensitive areas, things like financial services, industrials, materials, things of that nature. And this really is a trend reversal that we had been looking for some time. We do think it may be a trend that has legs looking forward. And I'll talk about some of the reasons why as we go through the remaining slides. I showed this chart when I spoke in October, and this one really just carries the data through the end of December. What we did was we looked at the S&P 500, probably the most commonly referenced index of US large cap stocks. And we broke it out into 5 companies, the big 5, you can call them the favored 5, the ones that really markets seem to favor. And then the other 495 companies, so the big five, our favored five, are in the light blue or the medium blue. The green is the S&P 500 as a whole, and then the grayish is the S&P 500 minus those five stocks. And you can see those five names really drove the lion's share of returns that we saw from the market last year. Even during the decline, you can see in the first quarter, those names actually held up better than the rest of the market. And when the market recovered, they continued to recover as well. I think there was more of a thematic tilt towards work from home names, names like Amazon being probably the most logical one that comes to mind, but also areas like Microsoft from cloud computing. And again, some of the more growth-oriented, technology-oriented names, and really the biggest of the stocks within the S&P 500. So there really was a period where those were kind of the favored ones, and everything else, was sort of put on the back burner, if you will. We again have started to see what we think represents a change from this kind of trend, and I'll show it another way. In this sense, we're looking at growth versus value. I mentioned before that, again, we've had a long period where growth has been doing very well at the expense of value. And what this chart shows, when the blue line is moving up, value is doing better. When it's moving down, growth is doing better. And you can see that from just before the global financial crisis, so through the last two recessions, we had a long period where growth did well. And again, growth typically doesn't do well during a recession. Often it is markets will transition away from growth stocks into other areas, but we didn't necessarily see that happen following the global financial crisis. We think this really has created a kind of pent-up demand for value stocks. And again, we did start to see a bit of a reversal. You can see that tiny check mark up towards the end of this chart. And this is, again, something that we think may persist. There's another chart that I'm going to show later on, which shows some of the impact of style leadership changes that you often see coming out of recession. And again, that is a trend that we think that we are expecting to see. And I think it's a trend that may have caught some people by surprise. Some people invest sort of assuming that what has done well recently will continue to do well. And that was the case for part of last year, but then it really kind of reversed itself during the fourth quarter. So again, that will lead in the topic of diversification when I talk about that in just a little while. Another area where we've seen kind of a divergence in returns over some time has been US stocks versus non-US stocks. You can see that coming out of the global financial crisis, US stocks, and this shows valuations of US stocks versus non-US. The green line shows how expensive US stocks are in terms of a price to earnings ratio. How much are you paying for $1 of earnings for a particular company? The red line is developed international markets. I'm sorry, the blue line is developed international markets. The red line is emerging international markets. So those economies that are younger, that are maybe less developed, things such as Brazil, for example, Mexico, areas that are often the population may be growing faster, the demographics may be good, but the markets, the economies may be a little bit newer, and thus labeled as emerging. And you can see that right now, US stocks are more expensive than both flavors of non-US. And that's not always the case. Again, there was a lot of reason for justification for this. Coming out of the global financial crisis, the US economy recovered faster, and I think recovered in a more robust way, because back then the Federal Reserve really took a lot of action to make sure that markets were backstopped and supported. And I think that really led to a long period of outperformance by the US. And that really just became even more augmented last year. Right now, certainly I think the U.S. is beginning to come out of the current recession, and whether it's over or not, we don't yet know. But it does look like we are in better shape than, say, Europe, for example, which is having some difficulty with vaccine distribution, having to go back into lockdown mode in some places. But there still may be opportunities outside the U.S. That have been presented, because you will not see one asset class dominate forever going forward. Asset class performance is cyclical, and you will see leadership change over time. And so we think the table may be set for other areas to really step up and assume leadership. Turning to bonds, and this is an area that often doesn't get a lot of attention, but this week has been a little bit different. This shows, and I'll re-explain what the yield curve is. Again, this really is just a plot of how long of bonds maturity length. So how long a term is the bond? Are you lending money to the US government for a period of 3 months, or for a period of 10 years, or for a period of 30 years? Depending how long you're lending the money, typically you're going to require a higher rate of interest to compensate you for tying up your money for a longer period of time. And then at the end of the period when the bond matures, you get your principal back. And so this plots interest rates by that period of maturity. Generally shorter maturity bonds, those towards the left, have lower rates, as I mentioned, and as you go towards the right, the rates are higher. What this chart shows is what interest rates looked like at the beginning of last year. So 12/31/2019, which is the dashed green line. You can see interest rates came down really across the board. When bond rates come down, prices are going up. There's an inverse relationship. And I think a lot of that was a flight to safety. When there was market volatility, people wanted to own the safest assets, and typically that means treasury bonds. And also concern about how quickly was the economy going to recover, and also the Federal Reserve doing a lot of bond buying to keep interest rates low in order to help the economic recovery happen. The bonds did begin to tick up. You can see from September through the end of last year. And if we plotted this now, it would be a much steeper yield curve. It would again start close to zero, but come up a little bit higher, given that the 10-year bond, for example, right now is just about back to the levels it was at the beginning of 2020. So we have certainly seen an increase in bond yields. And generally this is because of expectations for the economy. I think expectations for growth have improved over the last few months, and certainly the Federal Reserve noted that in their recent comments, and also concern about possible inflation. Because if inflation strikes, investors demand a higher yield in order to compensate for that. So we have seen more action in the bond markets. When you get your first quarter statements, you may see some negative returns from bonds. That does happen from time to time when rates do increase a fair amount in a short period of time. Doesn't necessarily mean that you have lost money until you've actually sold your bonds, but there can be periods where you have temporary negative returns. So don't be surprised to see that when you look at your statements, because there are periods where bonds can be out of favor when rates are rising. Now, in terms of our forward outlook, we always do this looking at both the good news, bad news, because there are always positive things to emphasize with markets and things to be cautious about. I would say right now the preponderance of evidence is more on the positive side, at least with respect to the economy. Maybe a little bit more neutral or not quite as positive with respect to the stock market, but there are still risks and concerns that we need to bear in mind. In terms of the good news, I mentioned it earlier, the vaccination distribution is certainly a positive. This is raising the possibility, and we certainly heard this from President Biden, that we may begin to see us moving towards a more normal, not completely normal, but a more normal economy and social environment by sometime around the second half of this year. Obviously, that will be a moving target depending on how quickly the vaccines are distributed, as long as they continue to show the safety and efficacy that they have shown in clinical trials, and as long as enough people get vaccinated and there is less resistance to doing that. In addition, there is a lot of support that is still coming from both the Federal Reserve, keeping interest rates very low and expected to keep them low for a while, and also from the U.S. Congress. Again, we just had an aid package come through. That certainly has begun to put a lot of money into consumers' pockets as well as businesses, states, and municipalities. The last time we had people receive funds, there was a significant uptick in consumer spending, so it would not be surprising if we saw that happen again. All of that really looks to, we think, be a boost for the economy as the year goes forward. The elections are in the rearview mirror. A lot of people are probably breathing a sigh of relief over that. And as they turned out, with the US Senate essentially tied at 50 with Vice President Harris serving as the tiebreaker, any legislation that gets through the Senate is going, would have to either be done with a filibuster-proof majority, which seems difficult at the moment, or it would have to be done via the reconciliation process and would still need to get approval from all 50 Democratic or independent senators. So not only senators like Elizabeth Warren and Bernie Sanders, but also more centrist or conservative Democrats such as Joe Manchin and Kyrsten Sinema. Generally, that's going to mean that legislation that passes will be less extreme and more on the moderate or centrist side. And I think markets have greeted that favorably. We also did see some removal of another question mark, which was concerning the Brexit deal. There was a partial resolution of that before year end. Work continues to be done to expand it from trading of merchandise to services, but there was a good step forward. And certainly the relationship between the UK and the EU is a very important one. And the ability of those two regions to continue to be able to trade with one another smoothly is quite important to the recovery of that region as a whole. I talked about the possibility, and we think probability, of a rotation into sectors that have been lagging. And again, this is something, and the next slide I think will show in a little more detail, but this is something that we are expecting to continue. This might not be a year where stocks are up dramatically. You typically don't see 3 years in a row of returns for the US stock market that are 10% or higher. We have had two consecutive years, so the odds of getting a third year, not to say it can't happen, but it does seem less likely. And so what we may see is, again, a movement, a rotation from some of the areas that have done well, the large cap, the mega cap, technology growth names, into other areas of the market. And that's really what we're looking for this year. And that would be consistent with prior historical trends. It will be important to keep an eye on the spread of the virus, especially with the variants that are out there, to also see if, to what extent economies either lock down or open up completely. And again, how good the uptake of the vaccine is. That will be very important, and I think that probably will dominate the news flow for some time. We do want to take a look at what the Federal Reserve is doing. Given that the head of the Treasury, Janet Yellen, used to be the head of the Federal Reserve, there probably is going to be as close a relationship, a working relationship between Fed and Treasury as there ever has been. We want to make sure that the Fed continues to act in an independent way. That probably isn't going to be an issue this year, but at some point the Fed will need to start raising rates, even if they are receiving some pressure to try to keep interest rates low in order to allow us to keep servicing the debt on our very large national debt. And it will be interesting to see what happens at that point. But again, that's probably a ways away. It will also be interesting to see what the next fiscal package is. There have been discussions about possible tax increases, whether it's on individuals or on the corporate tax rate. There are also maybe the possibility of regulation and other executive actions, all of which could have an impact on corporate profitability that would also have an impact on company earnings and potentially on the stock market as a whole. That's going to be worth monitoring as well as we get closer to the passage of the next bill at whatever point that happens. It's probably going to need to be done via reconciliation because it doesn't look like the filibuster is going to be going away. Now, that may include, finally, some infrastructure spending, as has been talked about for many years now. We'll have to see. But certainly that's something that I think markets are going to be eyeing. What will be the impact of any future legislation that comes down the pike? And the very last point, again, the possibility of inflation. I think that really was what kind of hurt the bond market and the stock market a bit this week because it was perceived that the economy was growing faster, I think, than people had expected. That was a stronger recovery. And often when that happens, that can lead to inflationary pressures. It can lead to more people coming into the workforce and therefore demanding higher salaries. Can also mean higher costs that are being passed on to end consumers by companies. And we did also have some disruption given the freeze in Texas, disruption of not only oil, but petroleum-related products, which are input feedstocks for a lot of other products. There have been some shortages of raw materials. There have been some logistical issues in terms of getting materials to and from production. Semiconductors, for example, there has not been enough production to meet the demand that's going into, for example, new automobile construction. And certainly housing construction also has meant increases in prices of lumber. There have been a number of these. And so I think it's typical when you see an improving economy, but that's worth keeping an eye on as well to make sure that inflation doesn't get out of control to the point where the Federal Reserve has to really step in dramatically in order to slow it down. Now, turning to another subject, I talked about this rotation, and I want to give a little historical context. What this chart shows, and I apologize if it's a little bit fuzzy, but look for the color coding. That'll probably tell you more. What we looked at was the last two recessions and then the current one. That's where the question marks are because we don't know what's going to happen going forward. So we looked at the 5 years leading up to the last two recessions, and then the 5 years after those recessions ended. And we looked at what asset classes did well in both of those periods. And what we saw generally was that the asset classes that did well going into a recession were often very different from what did well coming out of a recession. Recessions very often result in a change in market leadership. For example, you look to the Great Recession, the global financial crisis, you can see that going into that, U.S. growth stocks had actually experienced a negative return during that 5-year period, whereas coming out of that recession, they were essentially tied for the second strongest return after that the recession happened. So again, you can often see rotations. That's one of the reasons why we would be surprised if U.S. growth stocks, which have dominated over the last 5 years, or at least the 5 years up through the middle of June, if those continue to dominate for the next 5 years, because change normally is what you see coming out of a recession. I'll take this a little bit of a step further and look at year by year performance for different asset classes. So what we see here, again, color-coded, is how difficult it is to predict which asset class is going to do well in any given year. Again, sometimes asset classes will persist. You will see performance that is strong and continues to be strong, or weak and continues to be weak, like we saw with commodities in the early 2010s. But very often, you will sometimes see an asset class do poorly one year and then very well the next. So we looked at these particular asset classes, and we decided to look at what are 3 different ways that you could invest. So, and I'll show you these on the next slide, but we have two of the strategies involve buying the asset class that either was the best performing from the previous year or the worst performing from the previous year. So for example, in 2011, long duration bonds, so bonds out in the 20 to 30 year range, were the best performing asset class. So if you wanted to continue to buy those, you would at the beginning of 2012 say, okay, long duration bonds, that's what I want to own. That's what I'm going to buy for 2012, and then see how they do. Conversely, if you want to look at the worst performing asset class, that was emerging market stocks. So that strategy, you would buy emerging market stocks and see how they did in 2012. And at the end of each year, you would repeat. So what this means is, again, 3 different methodologies used to invest. And again, and this really is more of a hypothetical example, but I think it will give a good illustration of what a diversified portfolio, how it can behave relative to other types of investing styles. So again, the return chaser is buying that asset class that did the best the previous year, and then holding it for the full year, and then at the end of that year, doing it again with whatever asset class led during the most recent year. The contrarian strategy is buying the one that was worse the last year. And in a way, these are kind of like momentum and value, in that you're either assuming that what was strong last year will continue to be strong, or what was beaten down and cheap last year now maybe is due to bounce back. And then the third strategy that we looked at was just buy everything. Buy all 12 asset classes in equal amounts, and don't do anything more with that, but just diversify across all these asset classes and then see what happens. So we looked at the results on a year-by-year basis. And from what you can see here that on a calendar year basis, you would have been best off with the contrarian strategy. It would have won 5 out of those 10 years. It was the best performer. The return chaser, where buying the asset class that had done best the year before, that was the best performing of these 3 strategies in 4 of those calendar years. Whereas a diversifying strategy, just buying a little bit of everything, it only outperformed in 1 of those years. So just looking at this data, it might be tempting to conclude that really the diversified strategy is the worst one, that you should really take your chances with either the contrarian or the return chaser strategy. But that's only on a calendar year by calendar year basis. If you're a longer term investor, you're going to want to hold your investments for longer than 1 calendar year. So we looked at the full 10-year period. And here the results are very different. The return chaser did generate a positive return. The blue lines here show returns. The orange bars show volatility measured by standard deviation. So what you'd like is high returns and low volatility. With the return chaser, you got some positive returns, but reasonably high volatility. The contrarian, you actually wound up with a negative return for the full 10-year period and even more volatility. So you were not rewarded for the additional risk that you took. The best performer over that 10-year period was actually the diversified strategy. It had better returns and less risk than those other 2 strategies for the full 10 years. Any one of these strategies may do well in any given year, but over a longer time period, again, there is going to be change in leadership. There will be less persistence, or there has been less persistence than maybe people might expect. And some of the strategies, the return chaser and contrarian, when they work, they can work really well, but when they don't work, they can really hurt you. So I think, again, while this is more of a hypothetical example, I think this does make a good argument for why you want to stay diversified, because trying to predict what's going to happen is extremely difficult. We have thoughts and opinions about what we think is going to take place, but then surprising events like the pandemic last year can occur and really, throw assumptions out the window. So again, I think it's a good lesson to keep in mind. You don't always want to go into a portfolio and say, well, I just want to own, whatever's hot, whatever stock's going to do well, or Bitcoin or whatever it is. Because, if you swing for the fences that way, yes, you may do well, but you also may do really poorly. Generally speaking, we think the best way to get to your goals in a more reasonable and with a more reasonable degree of risk is by using a more diversified strategy. So with that, I'm happy to take questions. I will flip through some of the ending slides here that our good friends at Legal and Compliance always want us to show you. So I'll make sure to cut through these, and then I will pull out of screen sharing. And at that point, we can see what questions you might have. So let's see if I can end the slideshow and come back. Okay,
Yeah.
great.
Thanks, Matt. Always very informative. One question is, inflation appears to be the real boogeyman out there that could really derail some of what the positive things that are going on right now. How likely are we to see an uptick in inflation in the near term, midterm, long term?
I would say we don't think we are as likely to see one in the near term, at least a persistent one. You can sometimes get what appears to be inflation just because if prices have been kind of driven down to very low levels and they sort of rebound back to normal, that can look like a huge spike in inflation. It's really just kind of a normalization, not one that's going to be a long-term trend. That may be more of what we see this year. There will be more inflation, we think, at some point in the future. It's probably more in the out years, so not this necessarily this year, but further out than that. But certainly with the amount of stimulus that has been put in place, the amount of borrowing that central banks have done globally, and again, reaccelerating global economy, typically that's going to mean, and also we think if a weaker dollar continues, that's another factor because many commodities are priced in dollars. All of those could certainly lead to more inflation over time, but we don't know that it's going to be happening quite as immediately. And often I think markets will sort of ignore inflation for a while, and then it comes and suddenly they realize, oh, it's here, it's not dead, and then kind of over correct. And so that might have been what we've been seeing earlier this week.
So inflation has been kind of hovering around that 2%, probably a little bit low in reality, lower than that in reality. Is there an inflation number where you think the alarms would start to go off for investors?
I'm not, there probably is. I don't know if we would know it till we get to it, but
Right.
I know that the Federal Reserve is looking for greater than 2% for a little while. They've essentially set 2% as kind of the ideal rate of inflation, because you don't want to have zero inflation. Some inflation is good because it can allow companies to raise prices, to raise wages for workers. But if it's so, and inflation has been below 2% for so long that the Fed's willing to let it rise above 2% for some time, and they haven't really quantified it. They've said, I think, things like for an extended period of time, modestly above, so a lot of investors are trying to figure out what does that mean in terms of numbers. So, I mean, I would say if there is a big spike way above 2% and it looks like it's going to persist for a while, something like that might cause concern to investors. But if it looks transitory, or if it's just a little bit above 2%, but kind of settling in there, that might not be as problematic.
Right. So one of the things that you covered in pretty good detail there was the asset class rotation that we've seen. Is there anything that, other than people looking ahead, perhaps, that sparks the beginning of one of those asset class rotations?
Yeah, I think one of them certainly can be that whatever assets have been favored can become overvalued. Often they're favored for, they can be favored for a good reason. You look at those favored 5 companies, for example, they're very good companies. These aren't pets.com. These are throwing off cash. They're huge, franchises. But, the earnings assumptions kind of have to continue to get greater and greater, and that becomes harder and harder to achieve. Also, they may attract things like more regulatory attention. Certainly, we've seen that in Europe with some of the technology firms. And sometimes also it's, again, a changing economic environment. When you see interest rates start to go up, that can be difficult for growth stocks. Higher interest rates means that future earnings are worth less from an economic model. And so growth stocks are less attractive. And as the yield curve that we saw begins to steepen, that helps banks and insurance companies. They can borrow at cheap rates and lend out at more expensive rates. And those tend to be more value stocks than growth. So there are other factors too that can go along with it. But also sometimes it's like investor psychology too, that, they begin to see, stocks, people will describe stocks as looking tired, which is kind of anthropomorphizing something that shouldn't be. But there is a degree of truth because, markets are driven by human beings, and human beings sometimes do things that are rational and sometimes don't. So I think there is both an element of a change and also how people react to and what they think other people are going to do. All of that can be part of the mix.
Sure. Yeah, I always liked how they in economic textbooks they said the rational investor, right? Well, I've never seen a rational investor.
I've never met one in my
investor,
including me. Yeah.
Well, one of the questions, or probably the biggest question on a lot of people's minds right now, and I'll close on this, is with the pace at which we saw the recovery take place and the massive amounts of appreciation across multiple sectors, a lot of people have brought up the concern of, is this perhaps a bubble? So I'll leave it to you. What do you think?
I completely understand the question, especially because markets did recover so quickly last year. I would say that for the most part, it does not. There are parts within markets that do look bubble-like. Some of the cryptocurrencies, for example. I mean, the fact that there was one issued, and now I can't remember which rapper put it out, but there was one that was issued kind of as a joke, and it immediately
Dogecoin.
Yes, thank you. Yeah, that I think is a pretty good indication of a bubble. They're certainly, with the whole, GameStop trading situation, and that's a little bit different because that was more of sort of a play on short squeeze, and market could have been manipulation. I don't know if it meets that legal definition. But I think for the market overall, the market is responding to an improving economic situation. Earnings certainly were pretty good for the fourth quarter, will probably be very good for the first quarter. So it doesn't look like we are yet into bubble territory. A bubble usually happens when everyone is borrowing against their accounts to have more money to invest even more because they just know it's going to keep going up. When everyone has stock advice, when everyone assumes that they are more of an expert than professionals in the industry, it doesn't seem or feel like we are there yet. Certainly some stocks are expensive, but there are a lot of stocks that are still reasonably valued. And again, it's entirely possible that money could move from the expensive ones to the cheaper ones. So I don't know that we are quite at a bubble yet for the market overall, even if there are small bubbles that are within certain segments of the market.
Yeah. Well, this has been a tremendous insight into some of what SEI is thinking. I'm curious, can you share anything that SEI is doing to lean into some of these trends going on right now?
Yeah, in general terms, I would say that we did kind of expect to see a reflation trade happening. There are ways that you can position for that, whether it's positioning differently across different types of bonds, certain currencies that you can take advantage of, certain commodities. We've put in some opportunistic investments in areas like that. Even something like an equal weighted stock index as opposed to a cap weighted. So a cap weighted index, you're emphasizing those big companies more because they're a bigger part of the index, but equal weighting tends to emphasize those the other 495 companies within the S&P, for example. So those are a few things that we're doing, and also working with very good active managers and constantly keeping an eye on them and making sure that they're doing what we expect them to do. And that's something we're always doing.
Excellent, and that's why we love working with SEI. Matt, as always, it was a great pleasure having you today to speak to everyone. Matt has made the slides available to me, so we'll send those out to all the attendees that joined us tonight. And other than that, Matt, again, thank you.
Oh, my pleasure. Great to speak with everyone.
All right. Thanks for watching, everyone. See you later.
Take care.